So hey guys, it's Jerry Green from Bullish Trading, and today we're going to be talking about the common Forex trading terminologies. So if you are a beginner, you're new to the trading industry, you're new to the Forex world, you need to know some lingos that go around in the trading industry so that you don't look uninformed or you don't come off as someone who does not know what they are doing. And it's important that when you come into an industry or into a place for the first time, you get yourself acquainted to the things, the terms, the equipment and everything that is being used for effectiveness. So when it comes to Forex, there are some trading terminologies that you will need for the effectiveness of your trading journey, especially if you are a beginner. So we'll be moving on, and today we're going to be talking about 6 of them. We'll be starting with bullish and bearish. I know you've heard the term, okay, it's bullish, or the market is bullish, the market is bearish. What does it mean? We'll be talking about that in today's session. Long and short, you've heard hedge fund traders, or you've heard even normal retail traders, you've heard them use the term, okay, I'm going long on GU today, I'm going long on the pound today, I'm going short on the pound today. Even futures traders, even equity traders, trading generally, these terms, long and short, are being used throughout the trading industry, and we'll be explaining what they are in simple terms today, so that when you come to the charts tomorrow, or when you are in an event or somewhere that you come across the term, you'll be able to understand it and also explain it to whoever wants to listen. The third one is leverage and margin. This is super important and is most confusing, but today we'll explain it effectively in a way that you will understand it and you can even explain it. Leverage and margin. The fourth thing we're talking about today is PIP. What is a PIP? Definitely, you must definitely have heard of PIP or PIPs in the Forex trading industry or in the Forex world, or maybe you've heard someone or a retail trader mention it. You definitely need to know what a PIP is. It's actually the basic of the basics. So the fifth thing we'll be learning is bid and ask. You need to understand what bid price is, ask price. You need to understand and know what they are. And today we'll be explaining it in simple terms for you to understand it. The sixth, which is the last, is spread. We'll be explaining what a spread is so that when you come across this term or when you want to use it in your trading effectively, because of most of these things, you could actually find them in your charts, you can find them with your brokers, you can find them in your account. So you need to understand what they are overall, and we'll be explaining them in details and in simpler forms today. So moving on, the first is bullish bearish. What does it mean? Bullish bearish, just in simple terms, it means a trade direction. So when you hear the term bullish, or when I say bullish, it means the price is heading up. So bullish means the price is heading up. Bearish means the price is going down. Now, this analogy came because, let me give you an example. When you see a bull, it tends to want to lift its victim up with its horns. So when a bull approaches its victim, it lifts it up with its horns or with its head. So that's why we refer to price when it's heading up as bullish. So the bull lifting up its victim is the same thing as price going up. And when you see a bear tends to press down their victim, pushing it down. So we call it bearish. So it means price is going down. The same way a bear compresses or pushes down its victim, that's the same way we use the analogy in trading as bearish, meaning that the price is going down. So when you hear the term bullish and bearish, it simply just means that it's simply talking about a trade direction. Bullish means the price is heading up, and bearish means the price is heading down. Simple enough? The second thing we'll be moving on to is long and short. This also means trade direction. So when you hear the term, I'm going long on a particular asset class, let's say I'm going long on the pound today, it means that I expect the price to go up and I make profit when the price goes up. So when you hear futures traders say I'm long on the dollar, or you hear Forex traders or retail traders say I'm long on the dollar, they are expecting the price to go up and they make profit when the price goes up. And the second one is short. When you hear retail traders say I'm short on the dollar, they're expecting the price to go down and then they make profit when the price goes down. This also means that I'm buying the dollar. When I'm long, I'm buying the dollar. When I'm short, I'm selling the dollar. When I want to go long, I want to buy the dollar. When I want to go short, I want to sell the dollar. This is what it means. It is not complicated. So when you hear this lingo flying around in the trading industry, it's not complicated. It just means I want to buy the dollar, meaning I want to go long. I want to sell the dollar, meaning I want to go short. That's what it means. The third thing we'll be moving on to is leverage and margin. Leverage and margin. And leverage simply means how much larger you can trade relative to your account size. For example, leverage simply means how much larger you can trade relative to your account size. So it's more like an assistant from your broker. Your broker is the one that provides the leverage. It's more like an assistant from your broker relative to your account size. So now, for example, you have an account size that is $10,000 and you pick a leverage that is 1:50. Now, the leverage factor is 50 and your account size is $10,000. So the formula to calculate it is just leverage factor times account size. Now, the leverage factor is 50 and your account size is $10,000. When you multiply your leverage factor with your account size, that gives you a total of $500,000, which means using a leverage of 1:50 with an account size of $10,000, you can actually purchase or buy or partake in trading with up to $500,000 volume. Let me explain again for simpler understanding. If you have a leverage of 1:50 and your account size is $10,000, using the leverage of 1:50, you can actually buy a currency pair that is you can actually buy a currency pair using the volume of $500,000. That is just what it means. It is not complicated. The second example is, okay, and CJ, you just have to do this part again. Let me just start. So the third thing is leverage and margin. The leverage and margin simply means how much larger you can trade relative to your account size. Now, for example, if your account size is $10,000 and then you use a leverage of 1:50, your leverage factor is 50 and your account size is $10,000. When you multiply them, it gives you $500,000. This means that with $10,000, using a leverage of 1:50, you can actually trade let me use a currency thing. You can actually trade a currency peg using the volume of $500,000. So leverage tends to give you an assistance. The second example is if you have an account size of $10,000 and you use a leverage of 1:100, the leverage factor is 100 and your account size is $10,000. Using the formula, you multiply 100 times $10,000. This gives you an account size of $1 million. What does this mean? That if I have $10,000 with a leverage of 1:100, I can actually control or trade with a volume of $1 million in the market. Now, leverage is a double-edged sword, so you have to be careful because it can increase your risk and increase your profit potential. The second thing we'll be talking about is margin. Under leverage and margin, we're talking about margin. Now, margin is the small percentage of capital required to open and maintain a new position. I'm sure you would have seen this if you're using an MT4 platform. You see your profit, then you see your margin, and then the margin is simply saying that the small percentage of capital or amount that is required to open an account. A margin is simply calculated as 100 over leverage. So 100 over leverage, if I'm using the leverage like my previous example when I was using the leverage of 1:50. So 100 over 50 is equals to 2%, which means that on a $10,000 account, what I need to actually place a trade is just 2% of the $10,000 account. And this means that 2% of the $10,000 is just $2,000. This means that the margin gives you an opportunity to place a trade just using 2% of your current account. Now, margin and leverage are super powerful. They can increase your risks and expose you. It's a double-edged sword. It can expose you to a lot of risks if you don't know how to use them, because using a higher leverage gives you an opportunity to actually use a higher margin and also gives you an opportunity to make more profits or put more returns compared to when you're using a lower leverage. And that means you can actually lose more compared to when you're actually using a lower leverage. That's what leverage and margin is. So hey guys, if you're new to trading or you're an intermediate trader looking to up your game, you want to trade with our trading partners, EQ Markets Global. They are an award-winning broker and they actually offer low spreads, low commission. They have a 24-hour customer care service. You want to trade with this broker, we trust them because they are reliable, they are regulated, and they are one of the best in the trading industry. So if you want to up your trading game, sign up with the link in our bio and sign up with the link in the description of this video and get started with EQ Markets Global. Sign up and get started with EQ Markets Global. You want to trade with them. And now, moving forward, what is a pip? Pip simply means percentage in points. Pip is the smallest unit of measurement to express the change on the value between two currency pairs. That sounds like too much. That sounds like too much for a start, but let me just explain. It's very simple to understand. So if your USD moved from 1.1050 to 1.1051, remember it is the smallest unit of measurement. That means 0.001 USD has risen in value with 1 pip, just 1 pip, because it was 1.1050 before. It rose to 1.1051. That means that it has moved 1 pip higher. 1 pip higher. Now, a pip is usually the last decimal place in the price quote. Now, if your USD moves lower from 1.1050 to 1.1049, that means your USD has moved 1 pip lower. So, that last value, the 4 decimal place, that's how we measure pips. Now, most pairs go out to 4 decimal place, but there are like the Japanese pairs, the pairs that are paired up with the yen pairs are actually an exception. So any pair you see there mostly go out with 4 decimal places. The 4th one is what we use for measurement. But the yen pairs actually go out with 2 decimal places. So pairs like the euro yen, pairs like the dollar yen, you see, for example, okay, now we have, for example, the euro USD is 0.0001. That's how we measure their pip. They go out in 4 decimal places, but the USD JPY goes out with 0.01. You see the USD JPY has figures like 101.115. Those pairs, that last one, the second one, 101.115. The 101.11, that one is the value we use to measure. When there is a change in that value, we use it to measure the pip. Now, the last one, you see most brokers offer a last additional figure. That one is called pipette. It's called the pipette. It's mostly insignificant, but for educational basis, so you know, it's called the pipette. But the pip is measured with the 4th value for 4 decimal places, and then for yen pairs, it is measured with the 2nd value. So the pip, this is how we measure pip, a change in price movement. The smallest unit and the change in price movement is how we measure pips. Now, bid and ask. This is also simple. When trading Forex, there are 2 prices. Usually you see, okay, the price is just one, but it's actually not one. There are actually 2 prices. The bid means the price you can sell at, and the ask is the price you can buy at. So these 2 prices, what does it mean? So for example, you have Euro USD ask prices like 1.0803, and then the bid is 1.0800. You always buy at the ask. You always sell at the bid. Now, what does this mean? Now, it says, note the bid is always lower than the ask, and the ask is always higher than the bid. This price movement, if you notice there's a fluctuation. Euro USD price, the ask price is 1.0803. The bid is 1.0800, which means you're actually buying higher, and when you sell, you're actually selling lower. Why is this? Because there is a difference for price. When you buy at 1.0803. That's higher compared to when you sell 1.0800. This is because there is a difference in price. So you buy at the ask price, you sell at the bid price. And how you could tell this is just look at them, which is higher. If the You look at them and you tell which is higher. To know which is higher, when you identify the higher one, you know that is the ask price, because the ask is always higher than the bid. And the difference between the both of them brings us to the last, which is spread. Spread is the difference between the bid and the ask price. So you notice anytime you open your trade, your trade always, whether you take a sell or a buy, it starts with a loss. That is the difference in price. That loss is spread. That spread is how you pay your broker. That is your transaction cost, because your broker needs to make a living. So he makes his living through your execution. And when you execute your trade, there is a spread. The difference in price is the spread. That spread is what you pay your broker. The example, you have EURUSD ask price 1.0803, bid price 1.0800. The difference in price is 3 pips. 3 pips. That 3 pips is your spread. That spread is where you pay your broker. So if you buy at 1.0803, you pay your broker 3 pips. If you sell at 1.0800, you pay your broker 3 pips. So this will be all for today's session. The common trading terminologies, and in the summary, bullish bearish, trade direction. I'm bullish, I'm bad. When I'm bullish, I expect price to go up. When I'm bearish, the price is going down. Long, expect price to go up. Short, I'm selling, I expect price to go down. Leverage. Leverage is the amount of money your broker gives you to assist you in trading. So when you have an account size and you take a leverage, leverage gives you more access to volume, gives you access to more volume in the market, to control more asset classes or more trade size in the market. The margin is the amount of capital or amount needed in percentage or in dollars needed to trade or manage or open a trade. The pips is the smallest unit of measurement to measure the change in value. So when your USD moves from here to here, the measurement between this price level to this price level is known as, we measure it in pips. The bid price is the price the bid price is the price you sell at. The ask price is the price you buy at. The difference between the bid and the ask is known as spread. This will be all for today. We'll talk to you in the next video. Cheers and God bless.